The biggest risks to your financial future and your retirement often aren't the ones that you expect. They're not just about your overall net worth or if you've picked the right investments. The real danger often lies in the blind spots, the things that you just don't see coming until they knock your plan right off course. Christine Benz, Morningstar's Director of Personal Finance, has done some brilliant work on this. She's identified the 5 retirement blind spots that can derail even the best prepared professionals. And in my 20 plus years of working with many successful, wealthy, international families, I've seen every one of them in action. So in this video today, I'm going to walk you through those 5 blind spots. With each, I'm going to explain what most people get wrong. I'm going to share real life stories and give you practical steps to mitigate these risks and to help you fix them. By the end, you're going to see that true financial life and retirement success goes well beyond just hitting numbers. It's about building a structure, resilience, and clarity. So let's begin with the first blind spot. The first blind spot is timing risk, and it cuts both ways, both with your starting and your finishing line. Many professionals assume that they get to choose when they're going to retire, but life often has other ideas. Health issues, burnout, family responsibilities with aging parents, for example, or corporate politics can all bring the date forward unexpectedly. I recently worked with the managing partner of a top professional service firm in his mid-50s who expected to stay in a senior role for another 5 years. But after a firm restructure, he was nudged out earlier than he thought. Fortunately, he had more than enough in assets, but the shock forced him to reflect more deeply on what he actually wanted from his work, his life, and his financial future. And this is where the ICE framework comes in. Independent, continue earning. The idea with ICE isn't to cling into the corporate grind, nor to stop completely, but to build the freedom to underwrite a life of meaning and purpose to you, to do the work you want to do. To use the wisdom that you've gained from the grind of the first mountain to pivot successfully to do the work and live the life you truly want to on the second. That way, if circumstances do force your hand earlier, you're not caught unprepared. But timing risk isn't just about retiring sooner. It's also about living longer. Healthy, wealthy families are often planning a 20 or 30-year retirement, and it can sometimes easily stretch on to 40 or more. This means that your capital needs to last longer, and your spending must adapt across the different phases of retirement, from the go-go years to the slow-go years and on to the no-go years. The fix to all of this is flexibility, to build a detailed cash flow plan that stress tests both different scenarios, retiring 5 or 10 years earlier than expected and living well into your 90s and beyond. To do this, use phased spending or guardrails so your income adjusts to both the markets and to your planned lifestyle. With this approach, you're protected whether your retirement arrives sooner, later, or lasts longer than expected. Remember, even the wealthiest people need to create a plan for spending and for passing on their wealth, so they don't leave a horrible mess for their loved ones when time inevitably wins. And by the way, if you're a high net worth individual thinking about retirement in the next few years, we put together a free high net worth individual retirement checklist to help you decide if you're closer to retirement than you might think. You can grab it using the link in the description below. Once you've thought about timing, the next risk is what happens just after retirement begins, the sequence of returns. Now, this one's often a little less understood, but it can be absolutely devastating, because it's not the average return that matters over the years, but the order in which those returns occur. Retire into a downturn, start drawing down, and you could lock in losses at the very worst possible time. Someone who retired in January 2022, just as both stocks and bonds fell together, discovered this very painfully. Correct asset allocation, therefore, often makes a life-transforming difference. Correct asset allocation and building a war chest of safe assets can make all the difference. giving you the ability to ride out through rough markets without derailing your long-term plan. Even if you manage sequence of return risk, the next blind spot is yield. For years, savers have endured ultra-low rates. And whilst yields have improved recently, many investors still chase returns in exactly the wrong places. High-yield bonds sold by banks or complex products that look attractive but carry a lot of unseen risk. The action here is to keep fixed income very simple and high-quality government bonds, investment-grade funds, short-term inflation-protected securities. They may not be exciting, but they do the job. And in retirement, boring, or what I like to call high-end vanilla, is often exactly what protects you best. Of course, steady income means little if inflation eats away at your spending power. And that's the next potential blind spot. We've all felt this over recent years. What most people underestimate is just how quickly and quietly inflation eats away at your future purchasing power and therefore your opportunities for future wealth enjoyment within retirement, especially if you're living on fixed income. I often see families just sitting on far too much cash or grossly overweight with bonds, wrongly believing that this is a safe option and entirely unaware of the real cost of this lack of awareness around sensible capital allocation or portfolio structures. Outpacing inflation is the entire purpose behind prudent retirement planning. The key is building protection into your plan, both the war chest and global equities for long-term growth, and a cash flow model that is stress tested carefully against higher inflation scenarios. You don't need to predict inflation, but you do always need to prepare for it. And finally, the most personal blind spot: healthcare and long-term care cover. Many of us assume that insurance will cover everything, but extended medical or care costs can devastate even large portfolios and families. I've worked with families who discovered too late that their cover didn't stretch when they actually needed it. Now, the first wealth in life is always our health. So be proactive, budget explicitly for healthcare, and explore different options for long-term care funding without ignoring it. By planning for it now, you protect both your capital and your family's well-being when you'll need it most. And if you're serious about maximizing your wealth and enjoyment on life's second mountain, and you have over $1 million in cash, savings or investments, we offer a 90-minute retirement session personalized to your situation. We'll help you map out exactly when you can stop working, how much you can safely spend, and how to turn your capital assets into a flexible income plan. Use the link below to book your free call. So, those are the 5 blind spots Christine Benz highlighted, and I've seen them firsthand with many clients as well. The first one, timing risk, your start line and your finishing line. The second, sequence of return risk. The third is yield risk. The fourth, inflation risk. And the fifth, healthcare and long-term care risk. And the common theme: none of these are solved by simply having enough money. They're solved by clarity, flexibility, and sage structuring. Because retirement isn't just about hitting a number. It's about wisely building resilience into a detailed cash flow plan so that you can live with confidence and leave the legacy that you truly want. If you found this useful, please like or subscribe, and make sure you watch my next video where we'll show you how to avoid the biggest threat to your retirement.